And so people in the oil and gas industry have a great deal of worry that I know what the revenue I'm getting out of every well. So is that a cash generating unit? Do I have 4,000 cash generating units in my oil field, or do I have one? Under IFRS, and the way it's applied by most companies, they say significant cash generating units, and usually that'll be at a field level. So you're not going to have to do it on a well by well basis. You'll usually do it at your collection station where you're transmitting it out to a refinery and you're selling your oil and gas. At that transmission point would be your cash generating unit. At larger companies, it might be a refinery. It's flexible. That's the problem with cash generating unit. And with IFRS, in terms of it being principle based, it's not clearly defined. So here, most of us are going to fall into the cash generating unit being at field level. And you'll have to do your impairment test, which I'm going to go into later, based on that cash generating unit. And now there's a draft discussion paper on IFRS 6, which affects mineral properties. And the idea of that is to try to bring oil and gas into a similar treatment as mineral properties. Right now, under successful efforts, you're not able to defer as many costs as you are under a full cost accounting method, which is similar to what happens to mineral properties. So right now, the ICB is under a project, taking under a project to improve IFRS 6. The problem is that they've been trying to do this for 5 to 10 years. I can't remember exactly when they started it. And it's not expected at least until 2013. And I've asked some experts in the field, specifically oil and gas experts, because they're interested in when this is going to happen. I said, and I've been like, well, there's a discussion paper coming out right now. Do you expect it to be out in 2013 or any time for when we converge to IFRS? They've said no. They said, don't hold your breath. They've been working on it for 10 years. And it's 2013 at the earliest, they believe. So while there's a possibility of change, it's not going to come around for a while. And you're going to do the simple. So we just go back there for a second. And again, just to remind you guys, IFRS to IAS 16, the difference here is exploration stage. You're trying to see what's under there in IFRS 6. As soon as you're going to the development and production stage, you're moving to property, plant, and equipment, IAS 16. Let's go to the next one, and this is impairment, IAS 36. And the big difference here is in terms of how we do the test. Under Canadian GAAP, you're doing your undiscounted cash flows to determine if there's an impairment. So you're saying, here's my cash flows out for the next 20 years. There's no impairment on this asset. I don't have to impair it. If you actually did have an impairment revealed by those undiscounted cash flows, then to determine the impairment under Canadian GAAP, use discounted cash flows. Under IFRS, they say, use the discounted cash flows right away. Don't worry about undiscounted cash flows. And moreover, you're going to have to determine the net recoverable amount. The idea there is if you've got to pay commission, if you've got to pay a cost to dispose of this asset relating to the impairment, you have to include that in your cash flow. It can't just be the revenue, the cost to dispose of. So if you're selling a building and to determine the impairment on a building, you've got to pay a commission to a real estate agent. That would come off in your net recoverable amount, your commission to a real estate agent to sell it. And let's go into the next one. Asset retirement obligations. This is another area that we run into commonly. And the key difference here is under IFRS, it requires that ARO arises from a legal and constructive obligation. So right now in Canadian GAAP, we're dealing with legal obligations. Government says that I must reclaim this property. I've got an ARO. Under IFRS, they've expanded that to constructive obligation. I've made a social contract. I've said I'm going to do this. I've publicly stated it. I've got to include those costs as well. There's a couple of different ways you can think about a constructive obligation. I'm in a country that doesn't require me to reclaim land. I'm in, I'm not sure the laws in Ghana in terms of recovery, but maybe they don't have AROs. They're not required to recover the land. But they say you've told the government that I'm going to recover it, I'm going to put it back at the same level that it was before I got in there, you've got to actually calculate that cost and include it. It's not the legal obligation. You've told the government you're going to do something, even though you're not legally required to, so you've got a constructive obligation. Another one is I've got a regular ARO, but I'm going to go over and above, and I'm going to plant trees and put a park on top of the ground that I've ripped up. It's unlikely you're going to ever say that you're going to do that, but if you hadn't gone out and said that I'm going to do that in your MD&A and your disclosures, you'd have to include the cost to put the trees and the park on top of that land in your ARO. So it's not just a legal right, it's constructive in IFRS. The next part of it is an ARO in Canadian GAAP, you generally calculate once. As long as your asset retirement obligation at the end isn't changing. You do your single calculation, then you just accrete it up. Under IFRS, you have to update that calculation every reporting period, which creates, if you're doing quarterly reporting, you've got 4 calcs in a year. And what you're doing is you're not changing the actual ARO, the ending balance. You've got to update your interest rate, and you've got to consider your change in inflation for the current reporting period factors. For the most part, I don't think it's going to be significant change in terms of numbers. I mean, if you think about a couple percentage interest rate change on your ARO calc, it's not going to be material. You might be able to get away with doing it annually, but it is a requirement under IFRS to consider it every reporting period. Another point is accretion expense is going to become interest expense. It's not a big change, it's just a change in terminology. IAS 12, income taxes. This is something that people that were around for when it changed are going to be happy to see, that future income taxes and current income taxes will now be deferred taxes and current taxes. So we're going back to deferred. You can see a lot of chuckles out there. So all those people who had to learn it the wrong way can go back to learning it the right way. And another change is all deferred tax assets currently under IFRS are long-term. There's new IFRS that's coming out in 2010, which is expected to converge with the Canadian standard. So it will, and the expectation that they will split it up to the way that we're treating it right now with a current and a long-term asset. But right now, as IFRS is written, you're okay to go all deferred long-term. What simplifies it, definitely. Convertible debt. I'm not sure how many people have this in the room, but those who actually issued convertible debt, it's definitely a topic of interest for you because it's a complicated matter. And the big difference here is under IFRS, you must use the residual value method. Under Canadian GAAP, you get 3 choices. You could do, and it's the residual value after the liability is what you use under IFRS. Under Canadian GAAP, you have that option. Determine the value of your liability, and then you determine your equity component. Under Canadian GAAP, you could have also determined the fair value of your equity, and then figured out your liability. And then the third method, because we always use the residual value method, is the relative fair value. Under IFRS, you're going to use the residual value method where you determine the liability first. The idea here is I issued convertible debt at 10%. If I had issued non-convertible debt at 12%, that would have been at 12%. That gap between the 10 and the 12% is the fair value of the equity. That's what falls out. Because you push up the value of your liability to that 12%, and then what falls out is your equity. And that's the only method that's allowed under IFRS. And it's common practice. Most people in Canada are using that method. It's just your other options are gone. And I believe that is the end of my section.